Well, hello. Yes, it's another good morning. Today is Thursday, August 22nd, 2024, and I am Kenny Polcari, your host of the party. And here are the things that you need to know about what's going on in the market today. Well, that big number that everybody was worried about yesterday morning, in fact, wasn't really a big deal at all, right? Even though it did come down by 818,000 jobs. The FOMC minutes also didn't really reveal anything new at all. The Fed is still expected to cut rates by 25 basis points, while some are still stamping their feet about a 50 basis point rate cut. Markets are teasing the all-time highs. The question is, will it stall? And what do we have for dinner tonight? Well, considering what's going on, we're going to have the Bologna sandwich, but we'll get to that in a moment. So like I said, that big number, that preliminary annual payroll revision number, the one that was supposed to cause all kinds of angst, was revised, and it was revised downward by 818,000 jobs. That is the largest adjustment in more than 15 years and would suggest that the labor market has been cooling longer than the Fed has realized, putting the Fed behind the eight ball, forcing now for them to become more reactive versus proactive. Now, the adjustment of 818,000 jobs means that we created about 70,000 jobs per month less than what was reported between April 2023 and March of 24. That's a fairly large adjustment, one that's been rumored to create all kinds of angst, but in fact, it really didn't. And you want to know why? Because that significant weakness only empowers those that are betting on the rate cut. And now they can point to the fact that the Fed has to make a much bigger rate cut in order to catch up, to get in front of the eight ball versus behind the eight ball. Because the sense is that if we had known the real numbers at the time that they were reported, then the appearance would have been that the job market was getting weaker, and that would have forced or caused the Fed to have started cutting rates earlier this year. But since they didn't know, they didn't cut, which means that they must have to make a bigger cut now. And with that, stocks rallied. The Dow gaining 55 points, gaining 55 points back of the 62 they lost on Tuesday. The S&P added 23 points, 12 more points than they lost on Tuesday. The Nasdaq gained double the Tuesday loss, adding 102 points. The Russell rose by 28 points, 3 points more than the loss suffered on Tuesday. The shares was up 154 points, or 9 points more than the loss that they suffered on Tuesday, while the equal-weighted S&P rose by 50 points, or 20 more points than what they lost on Tuesday. Now, we are now once again not debating if the Fed is going to cut, but rather how much they're going to cut and how many times that they're going to cut before the end of the year. That's the question. Now look, I'm in the 25 basis point camp, and we're going to get it 3 times, right? September, November, and December. And that's where the bulk of the analysts and strategists are. The sense is that even with the payrolls adjustment, the U.S. economy is not circling the drain. So there's no need to suggest that it is. And that's exactly what a 50 basis point rate cut would suggest. Now, don't get me wrong. The 50 basis point camp guys are surely going to be disappointed if they don't get what they want. And you know what that means? That they're going to stamp their feet. Okay, great. It's time to move on. In any event, I think once JJ makes it clear, the market's going to back off because they've already priced it in. I expect it to be that buy the rumor, sell the news type of event for the traders and the Momo guys and the algos, right? They've run the market right back up since that August 5th disaster, and now we're kissing highs again. Long-term investors should use any pullback as an opportunity to buy stocks that go on sale. And that doesn't mean stocks that lose 3 or 4% of their value. It means let them come in. Let them come down 10 or 15%. That's a nice entry point to start your shopping spree. But again, it's all about you. You have to decide what makes sense for you. What are you willing to risk or to bet in terms of a pullback? And then we get the July FOMC minutes at 2 p.m. And that wasn't a barn burner either. There was nothing in there that changed what we already knew. Yes, some people went through it with a fine-tooth comb, looking for something, anything that might suggest that something was different. But let's be serious. There was nothing different. Did some think that we could have cut in July, some of the FOMC members? Yes, but guess what? We already knew that. They already made that clear. So like I said, there was nothing new. The only thing it did confirm, and again, we knew this, is that a September cut is alive and well. So again, it's just time to move on. Let's talk about this. The indexes and stocks are once again about to kiss their overbought range on their respective relative strength indexes. The Dow, the S&P, and the equal-weighted S&P are right there, while the NASDAQ, Russell, and transports are still approaching that overbought level. So don't be surprised if we move a little higher and test the highs of 5660 before we start to hit resistance and stall. Remember, stocks are typically weak during the August to October timeframe. This is like I've been saying it week after week. And after the swift move up from the lows of August, it demands that the market need to retest it, really to shake the branches and test investor support. Of the 11 S&P sectors, only the financials closed lower yesterday, down 0.2. Everyone else rose. Basic materials, the XLB, was the leader, up 1.15%. But remember, this sector has been underperforming all year, right? It's now up 7.2% as of yesterday, putting it in the 7th position of all the sectors. Only consumer discretionary, energy, and real estate are trailing it. Now, tech and communications are this year's leaders, up 29% and 23% respectively. Utilities, consumer staples, and healthcare, all boring, non-sexy sectors, are all up double digits as well, 18.5%, 15%, and 13% respectively. It's not so bad, huh? And I love it since I've been a big supporter of these groups all year. They're defensive, and I've been saying it. Small caps were also a beneficiary yesterday, as these companies will surely benefit from lower rates, right? Think that they have high borrowing needs. The Russell's year-to-date is now up 7%. The IJJ and IJT are up 5.4 and 8.9% respectively, so there's probably room to go there. Some analysts think that the SMIDs, the small and the mid caps, which have underperformed all year, have already priced in a slowdown in the economy. So if one comes, they actually may provide an opportunity for investors who are looking for value. Again, you should have some exposure to the sector, but I'm not overweighting it at all. I'm keeping it kind of, at that sector weight, 2.5%, maybe 3%. Bond prices rose, one, because nervous investors are trying to lock in those 3.9% and 3.8% rates before the Fed cuts, as some investors are also preparing for a market slowdown, right? That could send stocks lower. And if it sends stocks lower, bonds will surely go higher, and then yields will go lower. 10-year yields are now at 3.82%, while the 2-year yield is now at 3.9%. Government money market funds are still paying 5%, right? More bond buying, like I said, is going to send yields even lower from here, and the Fed hasn't even started cutting yet. Oil did what yesterday? Oh, right. It dropped another 1.7% to end the day at $71.94, slicing right through $72, a level that we've been discussing for a couple of weeks now. It did test as low as 71.5 before closing back at 71.94. Recall that when we broke through the long-term trend line at 75.85 and failed to take it back, I said that it meant that we were going to test those June and July lows of 72. And here we are. Now, if we fail to hold here at the 72 level, then the next stop is 70.5-ish. Gold continues to churn in the mid 2,500 century. This morning it's trading down $4 at 25.43. Support is at the 2,500 level. Resistance is yet undefined, right? Because we're really at the highs. Maybe it's 2,600. U.S. futures continue to push higher. Dow futures up 40, S&P's up 7, while the NASDAQ's up 45, and the Russell is down 2. Enjoy this ride. You are invested. It's all good. Just don't get drawn into this FOMO trade right here near the top. You're not missing out at all. Keep your cash liquid, earning 5% your government money market fund, ready to pounce when the pullback occurs. European markets are also higher, up between 0.2 and 0.6%. Eurozone PMI and UK PMI are all reflecting an increase in business activity, even as wage growth slows. And this supports another rate cut by the ECB when they meet in September as well. Investors across the zone are also awaiting today and tomorrow's Jackson Hole event. Remember, central bankers from around the world are in attendance, and they too hope that they're going to learn something new about what all these bankers are thinking in terms of rates, their economy, inflation, all that stuff. The S&P closed at 5620, up 24 points yesterday, and is now only 40 points, less than 1% away from the all-time high. Eco data today includes both manufacturing and services PMIs. Manufacturing is expected to be in contractionary territory. Services expected to be in expansionary territory. So it's a toss-up. Are we or aren't we in an economic slowdown? Existing home sales are expected to be up 1.3% month over month, but yesterday's mortgage apps were down a whopping 10%. So again, Are we or aren't we in an economic slowdown? No matter what their eco data says, though, the focus today and really tomorrow is going to remain squarely on JJ. So sit back and grab the popcorn. Give me a call if you're concerned. You can get me at 212-381-6194. Okay, what are we having dinner today? Well, we're having the fried bologna sandwich. Considering what I think is going on here at the DNC, then the bologna sandwich seems appropriate, right? So here you go. And guess what? It's also a favorite for a lot of us. It brings us back to our childhood. For this, you need a sandwich roll, you need butter, you need an onion, you need 4 slices of bologna, you need Dijon mustard, mayo, and some yellow American cheese. You're going to caramelize the thinly sliced onion in a saute pan. Then you're going to spread butter on the sliced roll. You're going to place that, butter side down on the grill or in the pan to toast it until it's nice and golden brown, then remove it. In the same pan, you're now going to add the bologna. You're going to heat it up. You're going to, when you get it all heated up and it's fried, you're going to stack 2 slices of bologna and top it with 1 slice of American cheese. And then take the other 2 slices, do the same thing. 2 slices of bologna, 1 slice of American cheese, and you kind of let it melt, right? This way, now you have 2 sets of bologna and cheese, right? While this is happening, you're going to spread some mustard and mayo on the toasted roll. You're going to add 1 layer of the caramelized onions, and then you're going to put 1 bologna with the melted cheese. You're going to add another layer of caramelized onions, and you're going to top that with the other stack of bologna and American cheese. You're going to then place the top of the bun on the sandwich, and you are really going to enjoy it. Cut it in half, enjoy it, whatever, a glass of milk, a glass of Coke, a glass of Pepsi, whatever you want. It brings us back to our childhood, at least the baby boomers, right? Brings us right back to our childhood. In any event, it is kind of a cloudy blue sky up there today. Not really stormy, but not really completely sunny. And maybe that portends how the market's going to react. Until, in any event, I'm going to be on with Charles Payne today in the 2 o'clock hour, and I'll be on with Stuart Varney tomorrow morning at 9 a.m. on Fox Business. So until then, take good care.